another day. It's 4:30 p.m. Eastern. You check your stocks and see that they are up. You feel good. There is something almost addictive about looking at your investments and seeing that they have gone up on a day. When they go down, you feel the opposite, down, sad or depressed. I'm sure this is all linked to the brain's dopamine response system. This system in the brain has a lot to do with why many people make bad decisions in their investing. When you see your stocks going up, you feel great because of this system. The dopamine response starts. You feel richer and great about yourself. If you see the stock market going up and your friends and family are bragging about how much money they are making in the stock market, then you feel like you are missing out. So you decide to enter into the market so you can have some of that great feeling. Of course, waiting until your friends and family are bragging about their gains is often not the best time to enter the market if you are looking for the short-term satisfaction or rush that quick gains provide. In the past 15 years, we have seen two major stock market crashes where this exact behavior caused many people to experience some short-term gains and then had to suffer through a period of severe loss. This severe loss syndrome causes your brain to experience fear and anxiety, and the brain chemistry almost propels you to once again do the exact wrong thing, sell. After all, you see the losses on your stock investments increasing every day, and you sell. Usually this emotional-based buying, when the market is raging, and selling when the market has tanked, leads to repeated severe losses. It is a major failure of our human emotional reward system mixed with the stock market. After experiencing this once or twice in your life, many people decide they will have nothing to do with stocks ever again. But let me tell you, when the next major rally comes along, people will start forgetting about their pain in the past, and many will repeat the experience. When this starts happening, it is often a sign of an imminent collapse. The solution, of course, is to rewire your brain. I find it dangerous to focus daily or weekly on the current value of your portfolio. Doing so can easily cause you to make bad decisions. It is important to not invest money in the stock market that you need to live on, or that you have allocated to your I lost my job fund, or the oh crap, I need to re-roof the house fund, or the car needs a new transmission fund. These kind of things seems to come up out of nowhere, and you need to have money set aside to pay for them. If you have all your money in the stock market and one of these emergencies comes up, you will have to pay for them, and if it happens that the stock market is down 20 or 30% from its peak, you will not want to sell, but will be forced to sell or take on debt to cover them. So my rule number 1 is to first set aside about 6 months of living expenses in a cash savings account before investing in the stock market. Some would say you should keep some of this fund in gold. Personally, I don't do this, but it could be a good idea, as it should in theory give you protection from inflation. This fund should be enough to cover emergencies that come up. If you think you need more savings, then save more. The whole point of this is to help you feel less stressed. Your money and investments should always make you less stressed, not more stressed. Once you have that fund in place, start investing in the stock market. Personally, I tend to not worry too much about timing the market when I make my purchases, but since I know the money I'm investing is not needed for my day-to-day life, and I know that by investing in solid companies that raise their dividends and earnings year after year and don't pay out more of their earnings in dividends, I need not worry about the month-to-month changes in the values of the holdings. Usually I save up money in my investing account until I have enough to trigger the next purchase of a stock. If during that time I see that the market is taking a pullback, or especially one of the stocks that I want to own more of has pulled back, then I will buy more of that stock. This has been a good strategy. When the stock takes a pullback, then you will get more shares of the stock for your money. Finally, my favorite tip is, instead of focusing on the value of your portfolio, focus on your monthly dividends. Every time you purchase shares, your dividends increase. Every time one of your companies raises the dividend, you get more each month. Set a goal for yourself as to what you want your monthly dividends to be and watch over time as you get closer and closer to your goal. Make a chart. This can be fun. When playing this game of watching your dividends grow, it can be easy to get into dividend traps, like companies that pay a high dividend that don't increase and are often at risk of cutting their payouts. If a company never increases their dividend, but their earnings increase year after year, it can still be a good investment, but usually when the dividend is stagnant, so are the earnings. These kind of investments are often in mature businesses that may be starting to shrink, or management is not creative in figuring out how to expand the business in new ways. There may be exceptions, but for the investment strategy that I prefer to follow, I like to focus on companies that are growing. I'm happiest with companies that pay between 1 to 4% in dividends. Often companies with 1 to 2.5% dividends offer the largest increases in payments year after year. So even though the income may seem small now, these types of companies offer the most growth, especially as you reinvest those dividends. Basically, I like to structure my portfolio with companies that pay lower, high growth dividends and also some higher, low growth dividends. But for me, companies that fail to raise their dividends almost every year are off of my radar. The sample portfolio is a good example of this. Focusing on my dividends and ignoring the value of my portfolio has been my most powerful tool to keep me invested through the ups and downs of the market. And when stocks tank, I can get shares of my favorite companies at dirt cheap prices. In fact, at such times, I'm often willing to take some of the cash from my emergency fund and put them into the market, because doing so, I can bump up my monthly dividends very quickly. And that is something to love when the markets tank.